Hi, I'm Tom Elliott with another property market update for Hodges Real Estate. The carbon tax is an issue which is now impacting the investment decisions of many people in the Australian economy. It's only been out a few days, but already it's causing quite a few ructions in the share market and will have implications for the property market as well. The price per tonne of carbon will increase gradually but systematically over time, and in a few years' time it will have a very big impact on what we do and how we live. The impact on the share market is already being felt. The share market has been quite weak since the carbon tax was imposed. On the property market, I would say that my predictions are this. Firstly, if the carbon tax stays in place, I think that inner city property is absolutely the way to go. It is unambiguously the case that the carbon tax will make transport to outlying areas more and more expensive. As a result, property that's near transport hubs and near established infrastructure will outperform. Since the global financial crisis of 2008, the Australian economy has been relatively immune to all the carnage that's been wrought on overseas economies. Now, right now in both the US and Europe, things are actually getting worse rather than better. Firstly, in the United States, the US government is rapidly approaching its debt ceiling of a whopping $14.3 trillion. As yet, there is no plan what to do in a few weeks' time when that debt ceiling is reached. If the US goes further into debt, that will be bad news. If it cuts back massively on government spending, that will also be bad news. I haven't seen any good news coming out of America for a while. Turning to Europe, and in the last couple of days, Moody's, the ratings agency, has downgraded Ireland's debt to junk status. As a result, the problems that at the moment are confined to Greece could soon spread to other countries like Ireland, like Italy, like Spain. Again, like the US, therefore, Western Europeans' economy is going to struggle to grow in the immediate term. With respect to the Australian economy, the news is a little bit better. The demand from China for our mineral exports continues to grow, although as many commentators are noting, the supply response from Australian iron ore mines, for example, is going up. Eventually, demand and supply will begin to intersect, and we might see the mineral and commodities boom slowing down. However, I don't think that's going to take place for a few years yet. Turning to unemployment data, and locally the unemployment rate was steady at 4.9%. However, what's important to note is that the participation rate across the Australian economy is falling. This means fewer people are now looking for jobs. Given how strongly the Australian economy has grown, I think it is actually going to slow a fair bit in the next 6 to 12 months. I also think that the unemployment data could start to turn worse fairly soon. That is, the unemployment rate could start rising a little bit. As a result of this, I think the Reserve Bank will now leave rates on hold at 4.75% for the foreseeable future. At the moment, shares are weak despite the relatively strong Australian economy because of the problems I've noted with both the US and European economies. It's very, very hard for our share prices to grow when share markets in those other parts of the Northern Hemisphere are struggling. As a result, over the next 6 months, I actually think money will turn back to the property market. It'll be seen as an oasis of relative calm and tranquility compared to the ultra-volatile share market at the moment. We have seen recently that clearance rates, particularly in residential property in capital cities around Australia, but most noticeably in Melbourne, have dropped off quite considerably. If I'm right and money starts to flow out of shares and into property, this means that now is unambiguously a very good time to buy. That's the end of this financial update. On behalf of Hodges Real Estate, thanks for watching. I'll look forward to your company again next month.